Hello and welcome. In this presentation, we'll explore how high net worth clients around the world approach wealth management. We'll explore a number of key regions which come with unique priorities and expectations. Understanding these differences is key to serving these clients effectively. Let's dive in. So let's begin with the topic of wealth itself. Wealth is infinite in how it can be managed. Most people think that our clients think all the same, namely get rich through stocks and bonds and become the next Warren Buffett. But this couldn't be further from the truth. A CEO in New York has different priorities for his wealth than an oil sheikh in Dubai. A family office in Switzerland operates on a different level than a tech entrepreneur from Singapore. Culture shapes the attitude towards wealth, and it is geography that influences those cultural norms. In this video, we'll break down client profiles from major world regions such as North America, Europe, Latin America, the Middle East, and the Asia Pacific. North American clients. Imagine a successful Wall Street investor or a Toronto real estate tycoon. They need their wealth to be managed, but under their terms. These clients view wealth management as a corporation, where they're entirely in control. Operating through a trusted advisor, the advisor acts like a coordinator who coordinates the tax lawyers, estate planners, and family office. Their number one priority is strictly separating business assets from personal assets. Why, you may ask? Because tax laws in the US and Canada are extremely complex, and there's always a lawsuit lurking in the water. They think long-term and have an appetite for financial vehicles such as ETFs, retirement structures, and tax-optimized plans. Not only that, but they expect their advisors to be predictable, accurate, and shield them from unnecessary taxes and litigation risks. The advisor in return must act like a CFO, running a corporation for them. Moving across the Atlantic, we come across the European clients. The Europeans have a generational mindset in place. Avoid unnecessary risk and focus on smooth transfers of wealth from generation to generation. This is partly why Europe is home to so many old money families. The goal isn't necessarily high returns, it's continuity. Because of this mindset, Europeans want to be highly tax optimized and use trusts, foundations, and wrappers to minimize their tax bill and protect them from political or legal risks. Europeans often favor tangible assets such as real estate, shipping, and family businesses so they can pass them down to their heirs. Europeans above all value discretion and loyalty and prefer having high trust relationships with their relationship managers. In order to accommodate European clients exceptionally, a banker must be active in succession planning and the preservation of their family's legacy. It's continuity that matters the most. Up next, we have Latin American clients, and they have one thing in mind, and that is security. These clients have lived through unpredictable regimes that have constantly threatened their wealth, namely due to inflation, asset seizures, and political instability. Therefore, offshore banking is not a luxury to them, it's an absolute necessity. Hotspots such as Miami, Switzerland, or Panama are their usual choices. They highly prioritize secrecy, asset protection, and swift movement of capital across borders. Preferring to work with one or two trusted bankers, they focus on buying US bills for purchasing power and are more inclined to wealth preservation than high-risk returns. To serve Latin Americans well, you must act as a gatekeeper who will protect the client's wealth, such as minimizing currency risk and keeping assets away from political volatility and offer legal structuring. In the land of Arabia, we have Middle Eastern clients. They focus on preserving wealth across generations, just like Europeans, but they also want to factor in keeping capital liquid and ready to move when new opportunities appear. Decisions on wealth preservation are influenced by a mix of religious and financial factors. For example, they prefer Sharia-compliant products like sukuks, which are interest-free Islamic bonds. Not only that, but they want investments that elevate their cultural position, such as real estate, which is seen as a symbol of prestige and respect. Therefore, they prefer capital protected and easy to understand investments. They generally avoid complex investment structures and are okay with risk as long as they see a reason to invest. To serve Middle Eastern clients effectively, a banker must be accommodating of religious and cultural matters, offer speed and flexibility, and access to high status asset classes. Moving north from the Middle East, we have clients from the Asian Pacific region, such as China, Hong Kong, and Japan. These clients are highly ambitious, first-generation entrepreneurs who have made their wealth in real estate, manufacturing, and tech. Their mindset is focused on aggressive growth, not passive investing. Because of this, they want hot, exclusive opportunities within their home region and prefer Asian markets and industries where they can leverage their connections. These clients work with multiple banks to diversify risk and have access to more opportunities. A private banker must act like an opportunity broker than a portfolio manager if you want to keep these clients happy. Offering early stage venture access, regional private equity, and co-investment deals become the norm for them. Instead of focusing on arbitrary risk models, a successful banker in this region is someone who's up to date on current events, offer information at lightning speed, and have a vast network of connections and opportunities. Conclusion. Despite the regional differences, high net worth clients share something in common to what they expect from their bankers. They want them to be precise in their expertise, have total discretion in their financial affairs, and above all, act like a trustworthy partner. They want their banker to offer customized solutions that are aligned with their financial landscape. They expect you to be proactive, anticipating their needs before they do. Deliver clear, useful information. Vague promises or messy reporting will not cut it. Understanding the value of time by offering reliable strategies that can build and protect their capital in an efficient manner. Basically, you're a strategist who thinks ahead of the game and not some salesperson that they can't rely on. This has been Alan Explains, and thanks for watching. Don't forget to like and subscribe, and I'll see you in the next one. Take care.